Wells Fargo permanently closed its doors, ending the megabank's centuries-long sovereign control over the world economy. The same bank was behind the millions of dollars in annual advertising campaigns urging individuals to manage their money responsibly and budget their way out of poverty. When something terrible happened, many individuals yearned to rejoice at the demise of the once declared too-big-to-fail bank. What led to the bank's demise? It may have been due to recent allegations of discriminatory lending or controversies like issues with the bank's blockchain and cryptocurrency that eventually came to light. Nobody is precisely sure what started the series of events that led to the bank's eventual closure by regulators. In today's video, we will take a deep dive into the mysterious downfall of Wells Fargo. Welcome to the Incredible channel, where we cure your boredom through spine-chilling investigations. Henry Wells and William G. Fargo teamed up with several other investors on March 18, 1852 in New York City to establish their eponymous company, which is now among the biggest banks in the world. The Overland Mail Company, also referred to as the Butterfield Line, was founded in 1857 by Wells, Fargo & Co. It offered regular mail and passenger service over an ever-increasing number of routes. The business established a reputation as a reputable one in the 1850s boom and bust era, and its iconic stagecoach logo rose to fame. Wells, Fargo & Co. basically ended as a transportation and delivery company when the American government nationalised its shipping routes and amalgamated them with the railroads into the American Railway Express during World War I. In a horrific earthquake that occurred in April of the following year, the banking centre was completely damaged. Still, the bank's operations kept expanding because the vaults were unharmed. Following two further mergers, the Wells Fargo Bank American Trust Company, which was shortened to the Wells Fargo Bank in 1962, grew to become and has since remained one of the largest banking organisations in the country. As of March 2022, Wells Fargo was ranked third among the top 5 banks in the US, after JP Morgan Chase and Bank of America. The corporation claims that its assets have reached $1.92 trillion. The bank has more than 265,000 workers and serves more than 64 million customers nationwide. As of July 2022, the bank's market capitalization was $165 billion. For the 2021 fiscal year, Wells Fargo recorded a net income of $21.5 billion. Financial services for wealthy people are referred to as wealth and investment management. This branch of Wells Fargo's business assists in various ways, such as establishing foundations or resolving inheritance problems before they emerge. Every affluent person knows that maintaining wealth can take almost as much effort as acquiring it, at least in the United States. Wells Fargo recorded a net income from wealth management of $2.2 trillion in 2021. If it seems significant, it is undoubtedly the least profitable of the bank's 3 business segments. In addition, Wells Fargo manages syndicated loans for energy, commercial real estate and crop insurance. Many Fortune 500 firms work with Wells Fargo for at least some of their wholesale banking needs. The bank uses a team-based approach, thus every employee will be involved in managing the millionaire's bank account. Because this team collaborates, clients may profit from using a variety of expertise when working their money. In addition to checking accounts, money market accounts, mortgages, certificates of deposits, and other personal lending services, Wells Fargo offers a wide range of additional goods and services. One of Wells Fargo's advantages is its scale and range of services. Corporate managers at Wells Fargo Bank started encouraging branch staff to participate in aggressive cross-selling in the early 2000s, which involves pitching consumers on various financial goods like bank accounts, credit cards, or overdraft protection services. Employees were frequently badgered about their progress and faced sales objectives, many of which were extremely difficult to reach. Failure to achieve these quotas had severe repercussions, including official reprimands and even termination. The expected outcome of this constant pressure was that many bank employees turned to illegal methods to reach their unattainable objectives. They marketed to customer goods they didn't need or couldn't afford. When even that needed to be more to meet management requirements, they opened accounts, credit cards, monitoring services, or loans without the client's knowledge or consent. Retail salespeople at the bank frequently engaged in these fraudulent operations with supervisors' blessing or encouragement. It's noteworthy that this conduct started long before the Consumer Financial Protection Bureau was established and operational. The Wells Fargo fake account scandal specifics started to become known in 2011, yet the practice persisted until at least 2016. The scandal's entire scope was then known to the public. Federal regulators discovered more than 2 million fictitious bank and credit card accounts between 2011 and 2016 in September of that year. By August 2017, Wells Fargo had revealed the existence of 3.5 million phony accounts dating back to 2009, after further investigations turned up even more instances. Customers of Wells Fargo who were affected, particularly those with lower incomes, suffered severe losses as a result of these fraudulent accounts. Although the total damages are probably far higher, the bank admitted to defrauding consumers of approximately $11 million in erroneous charges associated with the bogus accounts. The potential harm done to many people's credit scores by fake accounts is also significant, albeit it is more difficult to quantify in monetary terms. Many folks impacted by lousy credit reports may find it more difficult to get employment, rent an apartment, buy a home or a car, or get a loan. Federal authorities and the city of Los Angeles collaborated to take swift enforcement action against Wells Fargo in response to the bogus account crisis. In 2016, the bank agreed to pay the Consumer Financial Protection Bureau $100 million in fines for multiple CFPA violations and set aside an extra $5 million for consumer compensation. Wells Fargo also consented to pay $50 million to the city of Los Angeles as part of the settlement, and $35 million to the Federal Office of the Comptroller of the Currency. Although significant, this enforcement action did not address the full scope of Wells Fargo's malfeasance. Fortunately, many impacted account holders have successfully used the legal system to obtain some semblance of justice. Wells Fargo paid $142 million to resolve numerous class action lawsuits that may have affected millions of customers in July 2017. The agreement addresses complaints dating back to 2002. The settlement funds will aim to reimburse customers whose credit scores were harmed and compensate account holders to erroneous fees and charges. However, Wells Fargo may have shortened this settlement by abusing the compelled arbitration clauses in its consumer contracts, leaving the plaintiffs with insufficient money and possibly insulating the bank from additional liability. Wells Fargo attempted to halt the class action lawsuit shortly after it was started by invoking the mandatory arbitration agreements. The plaintiffs might have pressed for a more substantial settlement that would have adequately compensated them, had they not been threatened with being forced into arbitration. They might have foregone the compensation entirely and pursued their claims in court, which would have put Wells Fargo through discovery, and maybe unearthed even more proof of the type and scope of the bank's fraudulent operations. In further ongoing litigation resulting from its false account issue, including a class action lawsuit filed in a federal district court in Utah, Wells Fargo has persisted in trying to enforce the forced arbitration agreements. Wells Fargo's effort to compel the plaintiffs to pursue their claims through arbitration was ultimately refused by the judge in that case. Secondly, the foundations of the false account crisis were built in the early 2000s, years before any national regulatory initiatives aimed at safeguarding consumers of financial goods and services. Until crucial components of the CFPB's enforcement initiatives had been implemented, the full magnitude of the fraud became apparent. Third, despite its many flaws, the July 2017 deal with Wells Fargo demonstrates how legal victories have pushed for economic justice for account holders impacted by the false account crisis. Low-income customers of Wells Fargo will particularly benefit from the monetary compensation that the plaintiffs get as a part of the settlement, because making them pay for the bank's fraudulent acts would further jeopardize their capacity to maintain their economic stability. It may be even more critical to compensate low-income clients for the harm done to their credit ratings. Without access to reasonable credit, it is practically difficult for people to improve their financial situation in the modern economy. For instance, not having such access can be a significant barrier to engaging in the kinds of economic activities that help people generate wealth, like buying a home or going to college. Finally, the case demonstrates how corporate interests have successfully restricted real public access to the courts, undercutting efforts to advance economic and civil justice. The plaintiffs' acceptance of an insufficient amount of compensation as part of their July 2017 settlement with Wells Fargo was probably compelled by the widespread use of mandatory arbitration clauses, which had been made possible by favourable court judgments for corporate interests. Wells Fargo has consented to pay $3 billion to resolve allegations that the bank used dishonest sales tactics for over 10 years. The company admitted to charging millions of dollars in fees for debit cards, bank accounts, and other services that clients neither requested nor required. Thousands of Wells Fargo employees engaged in criminal behaviour to hit inflated sales goals. When companies cheat to compete, they harm customers and other competitors, Deputy Assistant Attorney General Michael Granston said in a statement. According to Andrew Murray, US Attorney for the Western District of North Carolina, the $3 billion fine is justified, given the staggering size, scope, and duration of Wells Fargo's criminal activity. Authorities claim bank executives knew about the illicit activity as early as 2002, but permitted it to continue until 2016. According to Nick Hanna, US Attorney for the Central District of California, this case illustrates a complete failure of leadership at multiple levels within the bank. Wells Fargo sacrificed its well-earned reputations for short-term gains, harming countless consumers. When it comes to business scandals, it's helpful to remember that, despite numerous official investigations, they frequently worsen after the initial disclosures. We do not intend this as a compliment when we say that the Wells Fargo unauthorized accounts incident is an outstanding example. The Office of the Comptroller of Currency, a significant federal financial regulator, has provided us with the most recent information regarding the Wells Fargo problems. Recently, the OCC launched a massive attack on several former bank officials, accusing them of additional offences related to the unauthorised accounts affair and demanding millions in fines and other disciplinary measures. When asked to share their experiences, Wells Fargo employees were outspoken about the bank's sales culture. Employees claimed that working in the bank's sales offices was worse than they could ever imagined in interviews with reporters. They spoke as if they had been conscripted as soldiers during a war or had been employed in sweatshops in the 1930s. I was in the 1991 Gulf War. I had less stress in the 1991 Gulf War than working for Wells Fargo. Employee message to Wells Fargo management. Supervisors threatened and made fun of the workers. As punishment, some were made to go outside on the scorching concrete in the sweltering sun. Imagine how much worse that discipline became as a result of climate change. Even in those days, when sidewalks and parking lot surfaces reached temperatures of 150 degrees Fahrenheit, it wasn't safe to be outside. If they didn't reach their sales targets, one employee was threatened with being transferred to a store where someone had been shot and killed. To summarise, it was found that sales staff at Wells Fargo's Community Bank, which is the retail division in charge of consumer savings, checking, and credit and debit cards, opened millions of unauthorised accounts and issued millions of unauthorised cards to meet harsh sales targets under threat of termination. The practice started in 2002 and continued for roughly 14 years. Investors have little faith in Wells Fargo's attempts to mend its image. The company will have to work tenaciously to regain its lost reputation. Make sure to let us know your thoughts down below. Subscribe to the channel as a sacrifice to the gods of the algorithm.